Hi, this is Taylor Nisi, Pleasant Street Wealth Advisors, and I'm here with our January 2024 market wrap. We're going to touch on January's capital market activity. We're going to talk about yesterday's CPI report and what it means for the markets, and we're going to wrap up with where we see opportunities for investors and how we are advising clients to manage in this environment. So in January, U.S. stocks posted modest gains to start the year, driven by mostly positive economic data. The Dow Jones Industrial Average rose 1.3%, the S&P 500 advanced 1.7%, and the Nasdaq added 1%. Large caps fared better than small caps in January, and the Russell 1000 index increased 1.4%, while the Russell 2000 dropped 3.9%. Growth outperformed value within both indices. And there's really four factors that are driving this market right now. It's number one, the assumption that the Fed cuts rates by May. Two is the continued disinflation. Three is strong economic growth and no signals for a hard landing. And four, strong corporate earnings. And so far, all of those stories are generally intact, even after yesterday's CPI report, which we'll talk about in a minute. 5 of the 11 sectors had a positive start to 2024. Communication services was January's sector leader with a 4.4% gain, followed by financials at 3.1%. The laggards this month were materials, consumer discretionary, and real estate, the last of which posted a 4.8% decline. Treasury yields had an uneventful start to the year as long-term treasuries posted slight increases. The 30-year rose 19 basis points to 4.22%, the most of any duration. The 1-month, 6-month, and 1-year T-bills all fell by single-digit basis points. The largely muted activity in treasury yields and treasury yield movement translated into little movement by short-term ETFs, although the iShares 20-year plus treasury bond ETF, ticker symbol TLT, fell 2.3%. On February 13th, a warmer than expected January CPI report was released, and this report raises four major issues. Number one, why did stocks drop yesterday? Number two, is this the start of a broader pullback? Number three, what would make this a full-blown correction? And number four, what sectors should outperform? In 2 slides, we're also going to share our updated market multiple table, which summarizes the key influences of the market and helps us figure out how those influences changing will move markets. So first, let's talk about why did stocks drop? They dropped because the market is priced to perfection. Period. End of story. And we're going to cover that on the next slide. But basically, the CPI report was not the perfect data that a market priced to perfection is looking for. The CPI report did not imply inflation was bouncing back. So our disinflation question from what's driving the market today is still intact. Headline CPI continued to decline to 3.1% from 3.4% year over year. And core CPI was flat at 3.9%. Core CPI will face downward pressure from housing sometime in the coming months. So yesterday's report showed that disinflation is still ongoing and that that is a very important distinction. And we want people to be aware of that because headlines are a little bit misleading this morning. So this is our market multiple table. You can see the key market influences in order of importance down the left-hand side. And then we highlight the 3 different scenarios. Current, things get better, things get worse. So put simply, yesterday's CPI report didn't really change the conversation on disinflation, our third most important market influence. Instead, it exposed that the S&P 500 at 5,000 is priced to absolute perfection, and yesterday's number was not perfect. Right? We can see that our things get better scenario has a market multiple of 20, and that would put the S&P at 4,920, which is below where we are today, which again shows that we're priced to perfection or potentially slightly overpriced. So that brings us to number 2. Question number 2, is this the start of a major pullback? And to answer the question there, I'd say I wouldn't be surprised to see a pullback in the order of 3 to 5%. Again, if you look at the math that we do here on a monthly basis, that would be totally reasonable. But to see a decline of 10% would be unexpected. Even considering yesterday's declines, the S&P 500 is still priced for a near perfect macro environment, while most other assets are singing a different song. The entire October to date rally in the S&P has been based off the idea of, again, to reiterate what I said earlier, sooner than expected Fed cuts, continued falling inflation, and a decline in the 10-year yield that helps to increase the market multiple. And all three of those have reversed back to November or December levels, yet the S&P remains 8% higher than it was in November or December. So to be clear, this does not mean that the medium or long-term outlook has shifted. It just means that we'll probably have some volatility in the short term. And that brings us to question 3. What could make things worse? I.e., what could make the medium and long-term outlook turn negative? A sudden rise in yields or a spike in growth concerns are the two factors that could change the outlook measurably. If you remember the summer and early fall of 2023, that market sell-off was caused by a sudden acceleration of treasury yields. It caused about over 10% market sell-off, and by market I mean S&P 500. Additionally, if we see growth rollover or we get a commercial real estate related financial failure, then concerns about stagflation could increase, which again would probably trigger an over 10% sell-off. So while we'll be watching the 10-year yields and economic growth data in the coming days, but unless we see that negative data occur, the items we just highlighted, the treasury yields or just slowdown in economic growth, we would view any pullback as just the market letting off some steam in an ongoing rally, not the end of the October 2023 to date present rally. And this brings us to our final question. What should outperform and where do we see opportunities in this market? In the event that the worst case scenario plays out and we see yields rise and economic growth slow, setting up conditions for the 2022-2023 recession that never came, we would expect less volatile and more value-oriented stocks to outperform. As we discussed on the first slide, and has been a consistent theme since October, value and dividend-paying companies should help. Value has been underperforming growth since October. Value and dividend-paying companies should help investors limit potential losses while maintaining positive exposure in the event of a market bounce. Regarding Supercap Tech in the Magnificent Seven, this specific group of stocks has proven very resilient to slowdowns in growth for the past few years. These companies should continue to do well if we see data that suggests a decline in growth. However, if we see the sharp rise in yields, we would expect a sell-off in this group. And it's important for people to remember that this group also makes up a much larger portion of the S&P 500 and many index strategies. So investors should be aware of their exposure to this specific group if you use broad-based indexes as part of your investment strategy. So to summarize the past few slides, we're still optimistic about the medium and long-term economic outlook. As of today, February 14th, 2024, there's no signal flashing a recession. There's no signal flashing a market sell-off. So as stewards of our clients' assets and advisors to families whose goal is to build wealth for their family, we still believe the best strategy is to align your investments with your financial plan and to continue to stick to your investment strategies. With that in mind, here are several important concepts from our past few months of market wraps that I believe are important for folks to keep in mind today. Many folks we're meeting with right now in our current are asking, if the market's priced to perfection, you show me the market multiple table and it has negative numbers for if things get better, if things get worse, or if things stay the same, why wouldn't I just stay in cash? I can get 5% in a money market account or a CD. Why would I even take the risk? And so this slide, it looks at the past 6 rate hike cycles and the subsequent 12-month market returns. And the story the data tells us is that once rates peak, investors are better off in stocks or bonds. Based on the current data we have and listening to the Fed speak in the past couple of weeks, we're fairly certain that rates are as high as they're going to go. So investors with cash on the sidelines, above and beyond their emergency fund and expected expenses in 2024, they should be thinking about getting back into the markets. And the reason why we're highlighting this is we don't know when the market's going to continue to go higher. It's higher than we would expect it right now. So who's to say it can't continue going higher? And at the same time, we obviously want to maintain those emergency levels because there is always the chance of a pullback and we don't want to sell depreciated assets to pay for things and if we can avoid it. So It's having that healthy balance and it's having our allocations aligned with our long term financial plans. But if your cash has grown over the past years and months, we would suggest looking for allocation opportunities in stocks and bonds. Looking specifically at bonds, we see a scenario where investors could get equity like returns from core fixed income positions. As a bond investor, it's important to remember that when you buy a bond, you become a lender. Most of your investment return is tied to the interest rate on the bond, with the average corporate bond currently offering 5.06%. We are only a few percentage points below the average historical return of the S&P 500. The blue bars on this slide show the expected price appreciation across the yield curve if we see rates decline 1%. So if the Fed comes in and does 4 cuts for 25 basis points each, we could see a scenario play out the way this slide is showing. So in that scenario, investors in investment grade corporate bonds could collect their 5% annual interest, and they could also see their bond portfolio increase in value 10 to 13% in investment grade corporate bonds, 12.8% here on the chart. So you could see something in the magnitude of a 10% increase in value, which would mean a 15 to 18% total return on an asset that's generally used to provide income and portfolio stability. So to us, that's a pretty interesting opportunity that we're highlighting to folks who are under allocated to bonds. Looking at the stock market, there are also many reasons to be optimistic despite the generally expensive market. Revenues were the largest contributor to earnings, with consumer strength and pricing power allowing companies to boost sales. Margins, however, have detracted from earnings as companies grapple with higher input and labor costs. In this past earnings season, a common theme was cost cutting and other corporate actions to defend and strengthen their margins. So, as we look to 2024 and 2025, expectations for double digit earnings growth seem a little bit too optimistic, as defending profit margins will become increasingly difficult in an environment of slowing economic growth and waning pricing power. However, high quality companies with strong balance sheets, ample cash balances, and sustainable earnings should perform well relative to the broader index. Through January, we're seeing strong outperformance of our actively managed strategies and continue to allocate funds from passive to active to benefit in an environment where there are clear winners and losers. And the final asset class to highlight today is the private markets. Regardless of what happens to the economic backdrop, investors are still looking for consistent outcomes across alpha, income, and diversification. The challenge is that you can't get all those outcomes from only stocks and bonds. However, when you expand the opportunity set outside of public markets, investors can leverage a range of different alternative assets to reach their desired outcomes. Indeed, as we show on the slide, alternative assets can offer lower correlations to public markets, diversified income streams, and enhanced long run returns. For instance, real assets shown towards the left, such as real estate, infrastructure, and transport, tend to be less correlated to the traditional 60/40 portfolio, while providing robust income. Private equity and venture capital towards the right provide much higher total returns, but come with higher correlations to public markets and little to no income generation. The classic 60/40 bond portfolio still looks attractive, but adding a sleeve of alternatives can help long-term investors achieve strategic goals through higher alpha, better diversification, and enhanced income. In particular, for investors looking to enhance returns, we like private equity. For investors looking to increase income, we like private credit. And for investors who are interested in dampening volatility, we like infrastructure. Thank you for your time today. If you have any questions, we'd love to hear from you. We'd love to discuss these ideas and opportunities in more detail.